I saw this news story today about USO, the leading oil exchange-traded fund. Let's just read the text in the first paragraph. It says, trading in United States Oil Fund LP, USO, one of the most popular ways for retail investors to gain exposure to crude oil futures, plunged more than 20% at its low on Tuesday, after being halted for news pending before the opening bell. The sponsor for the exchange-traded fund, USCF, says that it will suspend the creation of shares of the ETF as oil has been beaten down due to the oversupply and lack of storage. The ETF holds between 25% and 30% of the June contract for West Texas Intermediate oil. USO saw about $1.5 billion in inflows as retail investors have tried to pick the timing or the turning point for the embattled oil prices, which have been slammed due to lack of storage and price pressures amid the outbreak of the COVID-19 pandemic. Now, I underlined here the key portions of this that I would like everybody to pay attention to. Notice it says that it's a popular way for retail investors to gain exposure to crude oil futures. It doesn't say exposure to crude oil, it says exposure to the futures. I would argue that this use of the word investor in this sense is completely inappropriate. In the world of futures markets, those who buy and sell futures solely for the sake of profiting from price movements are speculators. Those who actually produce or consume the commodity are labeled commercials. Those who own shares of USO are obviously not interested in taking delivery of the actual oil. This makes them speculators. And because they have absolutely no idea of the nature of what it is that they own, I'd go as far as to call them uninformed speculators. Notice also that I underlined here that USO owned 25 to 35% of the June contract. This is an absolutely huge position for an entity that has no storage facilities and is not interested in taking delivery of its oil. It's not shown here, but in a Forbes article yesterday, it mentioned that USO also owned 25% of the May contract, which, as we saw, plunged in price yesterday. So what happens when an entity is set up to command such a large block of futures contracts with absolutely no facilities to deal with the actual underlying commodity? Well, let's continue my discussion from yesterday's video and see. So to recap from yesterday's video, here was the plot of futures prices for various contract durations at the close of this past Friday and very late in the trading day on Monday. With first notice day approaching, the owners of the May contract who either couldn't take delivery or didn't want to take delivery needed to get out of their contracts. The scramble drove the price of the May contract to extreme negative territory. Again, this wasn't oil itself that was negatively priced. It wasn't as if producers were willing to pay people to take their oil. No, this was futures holders who were willing to pay good money to get out of their contract positions and avoid having to default on their contractual obligation to take delivery. And here's the opportunity it created for the commercial players who actually did have storage capacity. Most of these commercial longs have been planning to take delivery over long periods of time, and they hedge their price exposure by holding long futures contracts along the entire duration curve. What they could do, assuming they had the ability to take delivery this week and store the oil, is sell some of their longer-dated futures contracts for cash and buy the distressed May contract and then stand for delivery. This would put $40 per barrel into their pockets just for using some of their unused capacity to store oil short-term. The long speculators would pay this price to get out of their contracts that they managed to lock themselves into. Of course, the act of taking advantage of this arbitrage opportunity would tend to generate buying pressure on the May contract and selling pressure for longer-dated futures, and this would bring the prices closer together. And sure enough, this is what happened. Notice that the May contract rose to about $10 per barrel, and the June contract fell to just a few dollars above that. Longer-dated futures fell too, just not as much. Overall, the price of oil along the curve dropped to reflect the changing expectations for oil demand over time. But we didn't see the wild gyrations in price observed on the near-term end of the curve. And the main reason for the wild gyrations of the near-dated futures? It was the speculative longs who boxed themselves in and needed to avoid having to stand for delivery of a commodity that they never intended to take delivery of. And just to complete the picture, Here is a summary of open interest at the end of the day yesterday compared to the end of the day today. Notice that the May contract open interest dropped by 95,000 contracts. What was left at the end of the day today was 13,000 contracts. So the 13,000 contracts represent real oil that will flow into storage. The 95,000 contracts represent the speculative longs needing to get out of the May contract and into longer dated contracts. You can see that most of the roll forward was into the June and July contracts. There were some additional adjustments all along the curve, but these were the big ones. Going out to January of 2022, you can see that the total open interest only changed by a modest 5,000 or so contracts. This is only a reduction of 0.25%. Speculative longs, including USO, succeeded in getting out of the May contract, but at great cost. And this is one of the reasons why you have to be very careful in the paper game. If you don't know what you're doing, you will have your head handed to you. If you participate unwittingly via an ETF, such as the USO, you will also get your head handed to you, but you'll be paying a bunch of asset managers a management fee while that's happening. Be aware of the commodity prices that you see broadcast. There is usually a lot happening under the hood. And what might appear on the surface to be a commodity price is really only the price of a contract.